We'll start with the fundamentals of project finance. What is it? At its most elemental level, it's raising money against the predictable cash flows of a defined asset. We can make a comparison of project finance to corporate finance. When would you use one versus the other? Well, project finance is really for large, capital-intensive projects with predictable cash flows. It's when you need to separate the risks and liabilities of that project from a parent company. It's where you might be looking for more leverage or more capital without burdening your corporate balance sheets, or where your corporate balance sheets as a whole may not be able to support financing, particularly of this level. It's also a situation where investors are comfortable with asset-based cash flows. On the other hand, corporate finance is really when you're looking for capital for general, flexible business growth and operations. It's when you need that flexibility to use those funds for whatever you may need. It's when you may have a strong corporate balance sheet or good creditworthiness already, or a very strong venture capital story. It's for shorter-term investments or acquisitions requiring agility. Now, let's talk about some key features of project financing. It's non-recourse, which means that it's not payable or due by the parent organization that might be operating or putting the project together. The obligation instead is to a special purpose vehicle, also known as an SPV, sometimes referred to as a special purpose entity. In the United States, these are typically LLCs, limited liability companies. They're easy to set up, they're easy to name, they're easy to have continuous ownership, and there are many different ways that taxation can be handled favorably. Project finance is based on long-term cash flows. So you wouldn't project finance something that doesn't have a long-term contract, for example, or doesn't have a long asset life. On the other hand, what you would project finance is something like an energy power plant that lasts a long time, or a vehicle that can also be used for a long time, that has some durability. You could even project finance things like bicycles or washing machines or other assets, whatever you can think of, that you can have a long cash flow and a long life. So, what are some large-scale applications for project finance? Solar or wind farm is a classic example, and template upon which most other project finance, at least in the clean tech space, has been built. In this, a developer will find land, build the energy assets, find an off-taker or someone who will purchase the power or lease the equipment, and establish all of the other elements required to put the project in place, like permitting, engineering, design, construction, and risk management. Now, a toll road or a bridge is perhaps the most classic example of project finance that one would typically encounter. In this case, a large organization, very often a public authority, but not always, will develop a toll road or a bridge based on a certain amount of traffic that's expected to cross that road or bridge. Then, based on those traffic expectations, you can go raise capital to build that road or bridge. The revenue or the tolls then become the important method for repayment of that debt. A third large-scale application would be an energy efficiency partnership. These are seen very commonly with public sector organizations that don't have the time to really upgrade all of their buildings to be the most efficient possible. Yet, these buildings have many efficiency opportunities and a lot of money-saving opportunities. So what will happen is a developer will come and say, hey, we will make all the energy efficiency upgrades. We'll swap out the lights, we'll improve the installation, we will swap out the old equipment that you may have that uses extra energy, and we'll pay for that. But in exchange, you'll share your savings with us. So this is commonly known as a shared savings agreement. Just like for solar, what's commonly referred to as a power purchase agreement to purchase the energy. There are two different customer contracts, but both are long-term contracts that enable projects to be secured and capital to build and fix those projects to be ready. Now, historically, project finance has worked on large-scale assets, but increasingly, smaller scale assets are seeing the benefits of project finance, and it's really quite diverse. You might see equipment lease agreements. Equipment leasing has been around for some time, but leasing of smaller equipment on long-term contracts can make a lot of sense, and it really fits into a project finance business model. Rooftop solar is another example. Just like one might install solar out in the field, you can install solar on small rooftops. When you aggregate those up into portfolios, that portfolio is something that fits very well into a project financing mechanism. Similarly with bike shares or EV charging. The sharing economy has grown over the past decade, and bike shares and electric vehicles both are ripe to be used only when you need them and to pay only for when you need them also. Being able to have that based on either subscription models or with a reliable forecast of usage. Either way, it provides long-term predictability for cash flows that can be project financed.